Hello all. This is Wayne Chambers with 36 Chambers Financial. Yeah, okay. So we've got this week we'll be talking about excuse me.
Okay, Google. What time's my first meeting?
Had all kinds of things going in front of me. So hello all. This is Wayne Chambers with that. So try not to keep it going. All kinds of things going. Okay, today we'll be talking about stock investments. And basically what I want to talk about is I've received questions and I've talked to individuals, and basic stock understanding is what they're trying to gain and how they can invest in the stock market themselves. First of all, you have to understand what stocks are. Basically, stocks are your shares of a company. Just real basic, excuse me, not going into anything really deep with it. So stocks are, that's basically you own a share of a company. That's where they get shares from. So you own a small piece of the company you're investing in. It's why a lot of times you'll see if you try to invest in the stock, they'll ask, do you own such and such percentage of this stock? If you own 51% of the stock, you have control of a particular company. That means that you basically determine the direction that the company is headed in. Not going to get into that yet. So basically what I want to talk about is the stocks themselves. Most people ask, is investing a good thing, a good way to earn some money and secure your future? Well, yes and no. If you're a small time investor and you're just starting off, that can be difficult to try to get money back from investing. Basically, for the average person, there are two types of stock. You have what they call common stock and what's called preferred stock. For the average person, what we're going to be focusing on solely is common stock, because that's what most people buy if you invest through a company, say like T. Rowe Price, or Capital One has their own investing app and all that right there. So we'll stick with common stock for now, even though anybody is able to invest in preferred stock. Common stock is an everyday stock. It's easy to buy. There's plenty of applications out there, plenty of companies that'll work with you to buy just everyday stock. So when we're talking about common stock and we're talking about beginning investors, first you got to determine how much money you have to invest. If you don't have a lot of money to invest, then it depends on what you're trying to garner from the stocks that you're investing in. Are you trying to use it as a way for quick cash? Are you trying to use it as a way for stable growth, trying to diversify your monetary portfolio, things like that? Understand that stocks can be lucrative and they can be devastatingly crippling when it comes to your finances. But the first thing when talking about the stock market or investing, the first thing is, do not invest any money that you cannot afford to lose all of. That means if you invest $1,000, you have to make sure that you are able to lose $1,000. If you're not able to lose $1,000, don't invest in the stock market. Because at any given time, all the money that you've invested can be gone. So, when you talk about investing, don't put in what you can't afford to lose. Now, when you invest in a stock, you want to know, are you trying to have a steady source of income? If you're trying to have a steady source of income, we'll talk about that for a moment. If you're trying to have a steady source of income, You want to invest in stocks that give you dividends. Basically, dividends are a portion of the profit that a particular company makes during the year, and they dish it out certain times of the year. It may be quarterly, it may be annually, it may be biannually. So you actually get money dependent on the amount of stocks that you currently own. Dividends is a great way to get this, to earn some extra money, but you also have to understand that you have to have a lot of shares of a particular company for those dividends to make you enough money to, say, retire on and live on a monthly basis. So if you had thousands of shares, that's why you hear people, they trade stock instead of giving bonuses. They'll give them 200,000 shares of a stock. But because those stocks are earning dividends, 200,000 shares of a stock at 1% is a couple $1,000s. So they get that money sometime during the year, whether they break it up, once again, annually, biannually, however they break it up, they'll get that money. So basically, they get that money every year, a percentage of the profits of 200,000 shares of stock. Now, when you start getting into how these people make millions of dollars off of stocks, that's one way. They have a couple million shares of a stock. So if that stock is dishing out 6%, you making money. If that stock is dishing out 1%, you still making money. And the thing is, research-wise, once a stock gives dividends, once they start advertising that they are giving dividends, it's very hard for them to take it back. So a stock that gives dividends will pretty much be a stock that gives dividends until the company closes, goes bankrupt, sells itself, what disappears from the face of the earth, whatever. Now, when you come to the average Joe, most people aren't going into, they just want to make some money off the stock and get out. Once again, you're talking about a volatile type of investment, which means it can go up and skyrocket, it can go down, or it can move pennies. Either way, what you want to do with a stock is determine how many shares of stock you need to buy for it to be profitable to you. If you've done your research, and always do your research on whatever company, stock, brand that you're trying to do, always do your research. See how they've moved in the last year. See how they've moved in the last 3 months, in the last month, in the last week. Check the company's future, where they're planning to go, what they're planning to do, any moves that they're trying to make. You have to check all of that when it comes to stocks. You can't just say, okay, I like music, so I'm gonna invest in some kind of music stock, or I like Apple, so I'm investing in Apple stock, because then you get how much each stock costs. Stock costs from pennies all the way up to thousands of dollars a share. So you're talking about stock that could possibly move pennies or $1, $2, $3 a share. The amount of stock that you have in that will determine how much money you actually make. So if I have stocks, and you have to understand that the higher the value of the stock, the harder it is for you to purchase the stock, the more steady the income is, steadier the income is from that stock. If you have stock that you bought at $10, that stock you will usually move $1 or $2. But how many shares of that stock can you buy? Now, if you bought 1,000 shares, which would cost you $10,000 at $10, and that stock moves a dollar, you made $1,000. You made $1 per share. You have 1,000 shares, so you made $1,000. Stocks in that range tend to move like that. Now, for those people that are listening and you're hearing everything about the penny stocks, their jumps tend to be a little more drastic. But then again, you can go in, spend $50 and get 10, 20,000 shares of a stock. But if you got 10 to 20,000 shares of a stock and that stock moves up less than a penny, that's how you get your profits from there. What happens with the penny stocks and why people become millionaires, because if you had a stock that's a penny, you bought 10,000 shares, for some reason that stock went to $1, you just made $10,000. That is rare, people. Don't get sucked into the penny stock thing. That is really rare for something like that to actually happen. And if someone tells you that it's going to be an easy investment, they are truthfully lying to you, which means they're telling you the truth in that it's going to be an easy investment, but that doesn't necessarily mean you're going to make any profit off of it. So watch the penny stocks. For new people, I would personally suggest probably getting into stocks that are a little more grounded. They don't have to be expensive. They can be anywhere from $5 to $10 stocks. You have great companies out there. You have Ford, car companies. You have IT companies out there, medical companies, things of that nature. So you have to know what kind of stocks that you're getting into so that you can understand to begin researching of how you think that particular stock is going to move. Stocks can be a great way to diversify your money, because let's go into the tax side. You put $10,000 into a stock, they only tax the dividends or the money that you make from that stock, and they only tax it when you take it out. So, and let me add this before I move on, and they can only tax it one time. So if you put $10,000 into purchasing stock, you made $1,500 off of it. They're only taxing at 15% the $1,500 you made off of it. Once that's taxed, they can only tax it one time, but you have to take that money out for them to tax it. If you haven't taken that money out, technically you don't have any cash. You just have shares, which is a piece of paper. It's just a piece of paper. I own a share in a company. So that's all you have. So you get people, when they get up there and they're making all this money, they invest in a company. They have 5-10 million shares. Off that 5 to 10 million shares, they make $20 million. They don't take the money out always. Sometimes they just leave the money there. So that $20 million, they made $20 million and it hasn't been taxed. And even after that, when they take that money out, it's the max it can currently be taxed at is 15%. I mean, that's a lot of money being taxed at 15%. But just think about that. Money that all they did was sit there in front of a computer like I'm doing right now and watch that money flow in. It comes, they take it out, it's taxed at 15%. The average Joe going to work made $60,000, $70,000, and a lot of them are being taxed at 25%. That's the argument when they come to those type of taxes and people getting away with that type of money. That's a lot of the argument when it comes to something like that. Now, for the stocks themselves, it's easy. There are several applications out there where you can start looking at stocks, start understanding stocks, learn how to follow a company, learn how to make an attempt to predict if a stock will rise or fall based on the information that's currently out there to the public. Capital One has one investing. T. Rowe Price has one. There are several ones out there. Ameritrade. You see all the commercials for a bunch of them. When you start dealing with these companies, one of the things to look for is how much they charge per trade. Now, and that's important because if you're not big, not spending a whole bunch of money, so you buy 2 shares of a stock. That stock may cost $100. So you spent $200. They charge you a price per that transaction, not per share, but per that transaction. So if it's, say, something like $7, you made a $200 share purchase. It cost you $7 was their commission. That's how they make their money. So $7 was their commission. Now the thing is, of course, if they go up $1 a piece, you still have not recouped your $7. So you need to recoup your money before you can even start making a profit. That comes into effect for the people who own the $5 to $10 range, because it will take longer to recoup that $7 as your stocks may go up 25 cents. So the amount of shares you purchase comes into play then. Because if I have a $5 stock, I purchase 100 shares, and each share goes up 25 cents, then you can recoup your money. So stocks are volatile. Stocks can be good for retirement. It can be a way to, with dividends, earn a little extra money. But like anything, the amount of money you put into it will directly relate to the amount of money you get out of it. This is in essence how rich stay rich. This is how people invest $10 million. A stock goes up. You get, let me rephrase that. You get 10 million shares of a stock. That stock goes up $2. You just made $20 million. So you doubled your money. That's how they make that money. And that's how they keep that money flowing for themselves. Understanding that allows the average person to get in and start investing in stocks. So like I said, there's nothing. Understanding stocks starts with research. Understand what you want to invest in. First, I would personally just first to start with the field that you want to invest in. From that field that you want to invest in, say the medical field as an example, look at some companies within that field. Narrow down maybe a particular area of interest that you want in that field. If you're in the medical field, say it's something with neurology. So you will see that you have business options, IT options, just all kinds of options, even narrowing it down there. So check those options out. Do your research and invest and do your investing from there. If you have any questions, of course you can hit me up. at my email, wchambers@36chambersfinancial.com, or give us a call, 844-463-6151. Okay, that's my topic. We discussed that a little bit. Now, you know what I'm saying, I want to get into, it's Christmas time, and from a financial perspective, we want to watch this spending. We really want to watch this spending, and we want to pay attention to your money. One of the things you want to pay attention to, especially in this time of how much money you're spending, is overdrafting your account. This is important. This is actually important because overdrafting your account makes money for the banks. Anybody who's talked to me knows how much me and banks are like oil and water. We can sit in the same place, but we just don't mix that well. Most banks will charge you an overdraft fee upwards of $35 or more for each transaction. So if you were at $1 and you spent $5, $5, you spent $5. The first one took you under. That's $35. The second one took you further under. That's another $35. The third one, another $35. So $15. $15 just cost you $15. Just cost you $105. Yeah, I hit the calculate on that because I couldn't hit it off the top of my head, because every time it's crazy how they do that. Now, banks got in trouble for this not too long ago. I need to look into it some more and see how they came up with it. But what they were doing was, say you had $50 in your account. You had 5 items come through that you charged. 4 of the items would have been under $50, and the last one was, say, $65. What they were doing was putting the $65 one through first, which overdraws your account, and then they let the other 4 go through. So basically, you had 5 $35 charges. So they made $175 off of those overdrawn charges. I know somebody a while back took them to court over that, because it was almost seeming that they were holding on to it, knowing that one charge, the highest charge, would go through first so they can make all this money. Now think about this. If 1 million people did this, which is a drop in the bucket in the American society. 1 million people is a lot of people, but in the overall scheme of the population, it's not. So that bank just made $175 million in overcharge fees. $175 million. Look how quickly that got out of hand. So the thing here, and what I'm advising you to do, is first watch your spending. First of all, watch your spending. Secondly, make sure that your charges have gone through before you try to charge something else. Make sure you understand the bottom line of all your charges that you're waiting to go through, because things like gas, if you use your debit card as a Visa, as a credit card, they charge $1, and then it goes through later. So depending on who it is, it may not go through for a day or two. You gotta watch that, because you're thinking it came out instantly, and you do see a charge for the gas. Scroll over, only $1 came out. So don't just think everything $30 came out and keep it rolling. This is why I always advise people to kind of in your mind have an idea of the balance of your account without always having to go to an ATM machine and getting the balance first. You should already have an idea of how much money you got that you have in your account. Secondly, make sure you don't have any fraudulent charges on your account that drive your account under. If you're talking to someone or if you're doing something online and they take your credit card talking about, we'll hold it, we're not going to charge it, we'll hold it, make sure you understand the manner in which they're holding it. Are they going to charge you $20 and just hold that $20 and at the end get a $20 back? Or are they just taking your card to have access to so they can charge it later? Because that comes into play, because if you're like a lot of people, you have very you have a very complex or simple or whatever, but a very strict way in the way you handle your money, so that everything is balanced and everything is right where you want it to be. So you know every charge that's coming out, you know the manner in which it's coming out, and you plan for that. So you need to watch out for things like that, because if they hit you with a charge, something doesn't go through. So they hit you with the $20, it dropped you below the threshold on Wednesday. We know you getting paid Friday. Don't think the bank is not going to hit you with that overcharge fee. And then your Friday pay is off because it went into your account. It covered the overdraft charge first because they're going to get their money first. And then now you got other stuff coming out that you had planned on that now you're $70 short. Think how simple that can go, and think how quick they can get you in the hole. Because if you bring home $500, your bills are $475, but you're already $50 in the hole, something short. Now you're in trouble. Now you got to figure out a way to juggle and pay another bill. So watch those charges, pay attention to those overcharge, and don't be afraid to call the bank. Don't be afraid to get on the phone and call them and say, look, I don't know where this charge came from. I don't know how it got there. It's fraudulent. And I need you all to take this back or stop this from happening. The banks will work. Most of the time they will work with you. Some have guidelines about that. A lot of them will reimburse you that overcharge fee, but they may only do it once a year, twice a year, or however, twice in 2 years or once every 2 years, whatever. So you have to be careful. This requires you to pay attention to your own money. We need to start paying attention to our own money. We need to start being aware of every advantage that they're taking of us so that we can stop that. So watch that spending out there, people. It can get out of hand, and we don't want, that's not something we want. So, all month I'm gonna be talking about ways to help with your Christmas spending, to help with your money saving, to not spend as much, and how big business is raking in on a holiday. So that's all I got for today. I answered somebody's question on the overcharge fee. I forgot who it was that hit me off. It was in casual conversation, but I've been asked enough about it that I decided to go ahead and bring it up. You all enjoy your week, the rest of your week. Enjoy your weekend. I'll see you next week right here, Wednesday, 9 p.m. Wayne Chambers, 36 Chambers Financial. And you all have a good day. Oh, don't forget to give us a call.